Welcome to this lesson on green bonds, part of our ethical investing series. Green bonds represent an innovative financial instrument that connects investors with environmental projects. These specialized securities allow individuals and institutions to support climate action while earning returns on their investments. Throughout this lesson, you'll learn what green bonds are, how they work, and why they've become a crucial tool in financing our planet's sustainable future. Green bonds are fixed-income securities, meaning they're essentially loans that investors make to organizations. What makes them special is their purpose. All proceeds raised must be used exclusively for climate and environmental projects with positive ecological impact. Structurally, they work just like traditional bonds, with regular interest payments and principal repayment at maturity. However, the key difference lies in transparency. Issuers must track and report how the funds are used, ensuring accountability. This combination of familiar investment structure with environmental purpose makes green bonds attractive to both traditional investors and those focused on sustainability. Green bonds can finance a wide range of environmental initiatives. Renewable energy projects include solar farms, wind turbines, hydroelectric facilities, and geothermal power plants that generate clean electricity. Energy efficiency improvements encompass building retrofits, energy-efficient appliances, and smart grid technology that reduces overall consumption. Clean transportation covers electric vehicle infrastructure, public transit systems, and cycling networks that lower carbon emissions. Water management projects include wastewater treatment facilities, water conservation systems, and sustainable irrigation technologies that protect this vital resource. Each category addresses specific environmental challenges while offering measurable benefits. Beyond the core categories, green bonds support additional critical environmental work. Biodiversity conservation projects focus on forest preservation, habitat restoration, and ecosystem protection that maintain natural balance. Circular economy initiatives include waste reduction programs, recycling facilities, and sustainable materials development that minimize resource consumption. Green buildings involve LEED-certified construction and sustainable urban development that reduce environmental footprints. Climate adaptation projects address pressing needs like flood defenses, drought management systems, and resilient infrastructure that helps communities withstand climate impacts. Together, these diverse project types demonstrate the comprehensive scope of green bond financing. To maintain credibility and prevent misuse, green bonds follow 4 core principles established by the International Capital Market Association. First, use of proceeds requires that all funds be allocated exclusively to eligible green projects with clearly defined environmental benefits. Second, project evaluation demands that issuers document their environmental objectives and assessment processes transparently. Third, management of proceeds stipulates that funds must be tracked separately with robust internal controls and oversight. Fourth, reporting mandates regular disclosure of both fund allocation and measurable environmental impact metrics. These principles create a framework of accountability that protects investors and ensures genuine environmental outcomes. Green bonds attract diverse issuers across multiple sectors. Governments issue sovereign and municipal green bonds to finance national and local climate initiatives, from renewable energy infrastructure to public transportation upgrades. Corporations use green bonds to fund sustainability projects within their operations, such as transitioning to clean energy or developing eco-friendly products. Financial institutions, particularly banks, issue green bonds to finance renewable energy loans and sustainable infrastructure development for their clients. Supranational bodies like the World Bank and regional development banks support global climate goals through large-scale green bond programs. Utilities issue green bonds to fund their transition from fossil fuels to clean power generation. This diversity of issuers creates a robust market with varying risk profiles and investment opportunities. Green bonds offer several compelling benefits. They create direct positive environmental impact through verified, measurable projects that address climate change. The market is experiencing strong growth with increasing investor demand, particularly from institutions with sustainability mandates. They provide portfolio diversification while aligning investments with personal or organizational values. For issuers, green bonds enhance reputation and build stakeholder trust. However, important risks exist. Greenwashing remains a concern when projects lack proper verification or overstate environmental benefits. The market suffers from limited standardization, with varying reporting frameworks making comparisons difficult. Green bonds carry the same financial risks as conventional bonds, including credit risk and interest rate risk. Finally, assessing actual environmental outcomes can be challenging, as impact measurement methodologies continue to evolve. Let's review the essential points about green bonds. These instruments channel capital directly into climate and environmental projects, creating a clear link between finance and positive ecological outcomes. They must follow the green bond principles, which establish standards for transparency, accountability, and credibility in the market. Due diligence is critical for investors to avoid greenwashing and verify that projects deliver genuine impact. Green bonds are accessible to a wide range of investors seeking values-aligned fixed-income opportunities without sacrificing financial returns. Ultimately, green bonds serve as a powerful bridge between finance and environmental responsibility, demonstrating that profitability and sustainability can work hand in hand. As the climate crisis intensifies, these instruments will play an increasingly vital role in funding the transition to a sustainable economy.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.